Somewhere in Frankfurt, in a building most people will never enter, a small group of central bank technologists finalized a participant list in October of last year. The list was published, the names were public, and almost no one read it. One of those names is the reason I am recording this video. While the financial press was busy covering ETF flows and US regulatory drama, the European Central Bank quietly opened a consultation on something the headlines have not understood yet: the question of how distributed ledger technology will interact with central bank money. Not commercial bank money, not retail crypto. The foundational layer, the reserve layer, the layer the entire Euro system rests on. They invited a project built on the XRP ledger to sit at that table. That single decision, made without fanfare, is the thread that connects every European story breaking right now.
Make sure to like and subscribe and drop a comment below with your opinion on XRP, and watch until the end, because the final minutes reveal why July 13th could change everything. Welcome back. I am the Calm Analyst. Today, we are pulling apart something the mainstream coverage has fragmented into 5 disconnected headlines and reassembling it into the single architecture it actually is. This is not commentary. This is structural analysis of what European institutions are building in real time, on infrastructure connected to one ledger. No hype, no predictions with dates, just the pattern, laid out the way the institutions themselves are laying it out, quietly, deliberately, and in plain sight for anyone who knows where to look. Let's go under the surface. To understand what is happening across Europe right now, you have to let go of how retail investors are taught to read financial news. The headline cycle treats every announcement as a discrete event. Ripple gets a license, the ECB makes a statement, a banking consortium launches a project. 3 different stories on 3 different days, covered by 3 different reporters who never speak to each other. That is not how institutional architecture is actually built. Institutional architecture is built in layers over years in regulatory channels that the financial press does not have access to. By the time a headline appears, the underlying work has been complete for months, sometimes years. The headline is the announcement of a decision, not the decision itself. And the people who understand this distinction are the people who position themselves before the headline arrives, not after. Here is the hard truth most retail investors miss. The European Union is not 27 independent regulators competing for jurisdiction. It is a single, integrated regulatory perimeter operating under a shared framework. When a financial institution earns authorization in one member state with passporting rights, that authorization clears the entire continent. 1 license, 27 countries, full operational reach. This is the mechanism the headlines never explain, and it is the mechanism that makes everything else in this story matter. When Ripple secured its full electronic money institution license through Luxembourg's financial regulator, the CSSF, it did not earn permission to operate in Luxembourg. It earned permission to offer regulated electronic money services and full payment infrastructure across every single EU member state through one of the most respected regulatory authorities in European finance, in the country that functions as the institutional capital of European fund management. That distinction is not marketing. It is structural. An electronic money institution holds formal authorization to issue digital money, process payments at institutional scale, and operate inside the regulated banking perimeter. It is not a bank in the traditional deposit-taking sense. It is something arguably more strategic, a payments infrastructure provider with legal standing to serve the institutions that are banks. And in Europe, the non-cash payments market that this license touches processed over 16 trillion euros in the first half of last year alone. 16 trillion. In 6 months. In one currency zone. That is the size of the door that just opened. But the door is only interesting because of what is already standing behind it. Ripple's European presence did not begin with this license. It began over a decade ago, with the formation of working relationships between Ripple and institutions like HSBC, UBS, and Western Union. Out of those relationships emerged the Global Payments Steering Group, a governance body composed of major financial institutions specifically organized to develop the rules and standards for using Ripple's technology in international payment flows. This is not infrastructure that was assembled last quarter. This is infrastructure with roots embedded into European institutional finance, going back to a time when most of the current crypto market did not exist yet. The license is not the beginning. The license is the regulatory formalization of a system that has been operating quietly at scale for years. Now let's do the math the headlines refuse to do. Ripple reports more than 75 licenses and registrations globally, over $95 billion in total transaction volume processed across its infrastructure, and reach into roughly 90% of the world's daily foreign exchange markets. Hold that last number in your head. 90% of global daily forex. The global foreign exchange market turns over approximately $7.5 trillion every single day. 90% reach means Ripple's settlement infrastructure has structural visibility into roughly $6.75 trillion of daily currency flow. Not theoretical exposure, operational reach. Now, layer the European piece on top. The EU non-cash payments market, the specific market the EMI license unlocks, processed 16 trillion euros in the first half of last year. Annualized, that is north of 30 trillion euros in payment flow inside the regulatory perimeter Ripple now operates within, end-to-end, across all 27 member states. Here's the calculation retail keeps avoiding. If a single payments infrastructure provider captures even 0.1% of that addressable flow, you are talking about 30 billion euros of annual transaction volume routed through XRP ledger settlement rails, 0.1%. The kind of number that sounds conservative until you realize what it implies about token velocity, liquidity demand, and the structural requirement for deeper on-ledger reserves. And that is just Europe. That is just payments. That does not include tokenization. That does not include the foreign exchange corridor business already running. That does not include the central bank money layer the ECB is evaluating separately. Now consider the supply side of this equation. XRP has a fixed cap of 100 billion tokens. Approximately 55 to 57 billion are in circulation, depending on the date you measure. The escrow releases roughly 1 billion tokens monthly, the vast majority of which are immediately relocked, leaving a net release into circulation that is a small fraction of that headline number. Now ask yourself a brutal question. If the institutional payment volume flowing through XRP ledger infrastructure is being measured in trillions of euros annually, and the liquid float of the underlying settlement asset is measured in tens of billions of tokens, what does the math require to happen to the per-token settlement value as utilization scales? This is not a price prediction. This is a liquidity equation. The higher the per-token settlement value, the fewer tokens required to clear a given transaction. The less slippage on institutional flows, the more efficient the rail becomes. The math does not point toward stability at current valuations. It points toward a structural revaluation that is a requirement of the system functioning at the scale it is being built to handle. If you have a problem with that math, you do not have a problem with my analysis. You have a problem with the basic mechanics of how settlement liquidity functions at institutional scale. This is where the picture stops being theoretical and starts being documented. Casey Slaughter, Ripple's managing director for the UK and Europe, was recently named one of Financial News' rising stars of European finance. That recognition does not come from press releases. It comes from delivered outcomes. Her own description of the past year was specific and verifiable. Ripple has delivered digital asset infrastructure into operational use at 2 of Europe's largest banks. She named them directly. BBVA, the major global bank headquartered in Spain with extensive operations across Europe and Latin America. Intesa Sanpaolo, one of Italy's largest banks by total assets. These are not pilot programs. These are confirmed delivery relationships at the scale where institutional reputations are committed publicly. On top of that, Ripple announced its first Europe-based investment management partnership. Aviva Investors, an asset manager with over £250 billion under management, is working with Ripple to tokenize traditional funds directly on the XRP ledger. Aviva did not select the XRP ledger by default. There is no default in institutional infrastructure decisions. Asset managers of that scale conduct multi-quarter technical evaluations, regulatory reviews, custody assessments, and operational testing before committing fund tokenization to a settlement layer. The selection of the XRP ledger was an evaluated commercial decision by one of Europe's largest asset managers, citing specifically the ledger's speed, low cost, institutional-grade settlement, and compliance-focused infrastructure built for regulated markets. And then there is the consortium piece, the part that most coverage mentioned and most viewers underestimated. A group of 37 European banks, organized through an initiative called Cavallis, has committed to developing euro stablecoin infrastructure. Separately, a parallel consortium involving UniCredit and BNP Paribas is preparing its own euro-pegged stablecoin for the second half of 2026. The named institutions across both efforts include DZ Bank, Intesa Sanpaolo, BBVA, BNP Paribas, ING, and UniCredit, institutions with documented operational ties to Ripple's payment network and the Global Payment Steering Group built around Ripple's settlement technology. Ask yourself what this means in practice. The same banks that are building Europe's euro stablecoin response to dollar-denominated stablecoin dominance are the banks already integrated in some form with the payment infrastructure that runs on the XRP ledger. This is not a coincidence of overlap. This is a single integrated network being formalized in two regulatory categories at once. While retail audiences are watching the surface price action and wondering why the chart does not reflect any of this, the institutional positioning has been unfolding in plain sight in regulatory filings, banking consortium announcements, and central bank consultation lists. The institutions are not waiting for the headline. They are writing the headline, one quiet authorization at a time. Now let me lay out what is on the calendar, because the timeline matters more than most viewers realize. The Euro Stablecoin Consortium launches in the second half of 2026. That is not a vague target. That is a publicly stated deployment window committed to by named institutions. When that infrastructure goes live, the underlying settlement and payment rails it depends on are not being built from scratch. They are integrating into systems that already exist, with Ripple's payment infrastructure as a documented part of the underlying architecture for the institutions involved. The European Commission's public consultation on the MiCA regulatory framework is currently open. MiCA, Markets in Crypto Assets, is the most comprehensive crypto regulatory framework in any major economy. The consultation is asking whether the framework remains, in the Commission's own words, fit for purpose, given the pace of global development. The outcome of that consultation will shape European crypto regulation for the next regulatory cycle. And the institutions providing input are not retail commentators. They are the same banks, asset managers, and payment infrastructure providers who have already positioned operationally. The ECB's push to centralize oversight of major crypto asset service providers under ESMA, the European Securities and Markets Authority based in Paris, is moving from proposal to implementation. The ECB's stated justification is direct. Large crypto firms are becoming systemically relevant and require unified oversight to prevent risk transmission into the broader banking system. Translation in plain language. The infrastructure has grown large enough that the central bank is now treating it the way it treats other systemically important financial infrastructure. And then the piece almost no one is tracking. The ECB's distributed ledger technology consultation through the Pontes Group remains active. Axiology, built on the XRP ledger, sits inside that consultation. The work is ongoing. The evaluation is real. The participants are not in that room as observers. They are there because the central bank is seriously assessing how this infrastructure interacts with the foundational layer of the European monetary system. When you stack these timelines side by side, the consortium deployment, the regulatory framework review, the oversight centralization, the central bank money evaluation, you are not looking at a series of independent events. You are looking at the formalization phase of a single integrated build-out. The countdown is not theoretical. It is on the official calendars of 3 of Europe's most consequential financial institutions. Here is what most retail investors will only understand in retrospect. The window of accessibility, the period during which the underlying settlement asset is available at retail accessible pricing, exists because the institutional infrastructure has not yet entered its operational utilization phase. That phase is what comes after the licenses, after the consortium launches, after the central bank evaluations conclude, and the systems move from approval to live transactional load. Once that transition happens, the dynamics shift. The exchange available float of XRP is already a small fraction of the total supply when you subtract escrow, institutional cold storage, lost tokens, and long-term holdings. As institutional utilization scales into the payments and tokenization rails being formalized right now, on-ledger settlement reserves are not optional. They are a structural requirement. Tokens that move from exchange order books into institutional custody for settlement liquidity do not return to retail markets when the price ticks up 10%. They are operational reserves, not speculative positions. We are moving from an era where the float was abundant relative to demand to an era where the float will be measured against institutional settlement requirements at continental scale. That transition does not happen at a single moment. It happens gradually and then suddenly, in the way most structural revaluations occur. The institutional players who are currently positioning are not doing so because they believe in a price target. They are doing so because they need operational reserves of the asset to run the infrastructure they have committed to deploying. That is a structurally different category of demand than speculative accumulation. It does not negotiate on price. It executes on requirement. The viewers who understand this distinction are positioning themselves before the operational demand becomes visible in the price action. The viewers who do not understand it will be reading articles in 18 months about how the institutional accumulation phase happened in plain sight, and wondering how they missed it. The door has not closed, but the framing of who is on which side of the door is being decided right now, in the quiet phase before the operational rails go live. I know the past several quarters have not been easy for anyone watching this asset closely. The headlines have been sparse. The price action has been frustrating. The conversations around you have been filled with people questioning the thesis, pointing at other assets, asking why this one has not moved. I want to be direct with you about what that period actually was, in retrospect. It was the accumulation phase. It was the regulatory groundwork phase. It was the period during which the institutional build-out, we are now seeing the headlines of, was being constructed in the channels the financial press does not cover. The silence was not absence. It was the sound of infrastructure being assembled in the rooms that matter. Being early is psychologically indistinguishable from being wrong, right up until the moment the structure becomes visible, and the people who waited realize what they were watching all along. The discomfort of holding through that period is the price of position. The viewers who held are not holding because they are stubborn. They are holding because they understood, on some level, that the structural story was bigger than the surface noise. What is happening across Europe right now is the validation of that conviction, not in the form of a price spike, in the form of documented institutional integration at the highest level. Central banks, major asset managers, banking consortiums, and the regulatory frameworks that govern them. The question is no longer whether the thesis is intact. The question is whether you will still be holding the position you built during the quiet phase, when the operational utilization phase begins, and the institutional demand becomes structurally visible? That is a question only you can answer. But the data side of the answer, the part I can give you, is unambiguous. The structure is being built. The institutions are committed. The timelines are on official calendars. The infrastructure runs on a single ledger that you have access to right now, in a way that the next phase of the cycle will not necessarily preserve. Make sure to like and subscribe and drop a comment below with your opinion on XRP. And watch until the end, because the final minutes reveal why July 13th could change everything. Let me leave you with the framing that matters. There are two ways to interpret the European story breaking across the headlines this month. The first is the way the financial press is presenting it, as a series of disconnected announcements, each interesting in isolation, none of them connected to a larger thesis. That interpretation is comfortable because it does not require you to act on anything. The second interpretation is the one this video has laid out. 5 separate institutional moves in 5 different regulatory and commercial channels, all converging on infrastructure connected to a single ledger, on a timeline that is publicly documented and rapidly approaching its operational phase. That interpretation is uncomfortable because it implies the structural revaluation of the underlying settlement asset is not a question of if. It is a question of when and a question of who is still holding position when it occurs. I am not here to tell you what to do with that interpretation. I am here to make sure you have access to the structural picture the headlines have not connected for you. The signal is in the convergence. The convergence is documented. And the institutions building this architecture are not waiting for retail to understand it. If this analysis gave you a clearer picture of what is being constructed across Europe right now, comment the word convergence below. I want to see who actually made it to the end of this one. Subscribe if you value this kind of structural deep dive, because the next phase of this story is going to require a clearer head than the headline cycle is going to give you.